The bank approved David and Emma for $620,000. They bought at $590,000, responsibly under their limit. Or so they thought. 18 months later, they hadn't been to a restaurant in 4 months. Their car needed repairs they couldn't afford. Their emergency fund was gone. They owned a home and could afford almost nothing else. In this video, I'm going to show you 3 things. First, why bank approval has almost nothing to do with actual affordability. Second, the real affordability calculation, with a framework you can apply to your own numbers. Third, the pre-purchase stress test most buyers never do. That reveals whether a purchase is sustainable before signing. Stay with me. Before I show you the real calculation, I need to explain what banks actually measure when they approve a mortgage. Because it's not what most people think. Banks measure one thing: debt-to-income ratio. Typically, they approve borrowers whose total debt payments don't exceed 43% to 45% of gross income. Gross, before tax. David and Emma's gross income, $140,000. 45% of gross, $63,000 per year. $5,250 per month. Their mortgage payment fit within that threshold. So the bank approved them. What the bank did not measure: childcare costs, $1,800 per month. Car payments and insurance, $780 per month. Student loan payments, $420 per month. Groceries, utilities, phone, internet. The actual cost of living 2 real lives in a real city. The bank looked at one ratio and called it affordability. It isn't. Here's the twist. Bank approval is not a financial recommendation. It is a credit risk assessment. The bank is asking one question: is this person likely to make their payments? Not, will this person be financially comfortable after buying? These are completely different questions, and only one of them matters to the bank. Now, the real affordability calculation. Step 1. Start with take-home pay, not gross. David and Emma's take-home, approximately $98,000 per year. $8,165 per month. Step 2. List all fixed monthly obligations. Mortgage including taxes, insurance maintenance, $3,740. Childcare, $1,800. Car payments and insurance, $780. Student loans, $420. Total fixed, $6,740 per month. Step 3. Calculate what remains. $8,165 minus $6,740. Remaining for everything else, $1,425 per month. Groceries, utilities, phone, internet, clothing, healthcare copays, entertainment, savings, emergency fund, everything. $1,425 for 2 adults and a child. That is house poor. Not broke, not failing. House poor, owning an asset, while having almost no financial flexibility. Step 4. The stress test. What happens if one income disappears for 3 months? What happens if the car needs a $3,000 repair? What happens if a medical bill arrives? David and Emma failed all 3 questions before they bought. They just never asked them. Here's the most important twist. The 28% rule says housing costs should be under 28% of gross income. David and Emma's mortgage alone was 25% of gross, within the guideline. But their total fixed costs consumed 82% of take-home pay. Guidelines built on gross income, in a world of high taxes and high living costs, can be dangerously misleading. What the financially comfortable homeowners did differently. They calculated from take-home pay, not gross. They included every fixed cost, not just the mortgage. They left at least 20% to 25% of take-home for variable expenses and savings. after all fixed costs. They ran 3 stress test scenarios before signing anything, and they waited until the numbers passed all 3 before buying. Here's the most important twist. David and Emma aren't struggling because they made a bad decision. They're struggling because nobody gave them the right framework. Before they made it, the bank's approval was never designed to protect them. It was designed to assess the bank's risk. Those are not the same thing. The bank said $620,000. David and Emma bought at $590,000 and couldn't afford a restaurant for 4 months because approval and affordability are not the same number. This video just opened a window for you. You've seen the real calculation, the stress test most buyers never run, and why bank approval means less than most people think. What you do with that window is completely yours, because everyone's situation is different. One question before you go. Have you ever calculated housing affordability from take-home pay? Not gross income. Drop it in the comments. Next week, why your parents could buy a home and you can't. The generational shift nobody fully explains. Subscribe, hit the bell. See you next week. Educational content only, not financial, legal, or real estate advice. Always consult a qualified professional in your area.